The crypto market is not just growing, it's also evolving very rapidly. In the early days, we only had trading on the chains. Then we had centralized exchanges. Then we had the introduction of levered products like perpetual futures. And that's now what's driving the price development of SOI. Have a look at this chart. In yellow, we see the spot price of SOI, and in green, we see the open interest. So this is how many bets are currently made on the SOI price. And this is in the billions. It's currently above 1 billion in open interest. The more people bet on the SOI price, the higher the spot markets tends to go as well. When then leverage comes down, the spot market follows. So it's not anymore tens of thousands of retail investors that buy a few $100 worth of a token that's moving the price. Instead, it's a lot of leverage, potentially also by the market makers and by the whales, that's actually moving the price. Now, usually for most assets, it costs money to bet on rising prices because we get more exposure, right? Long-term prices go up. And that's why for most assets, we see the open interest funding rate being positive. It costs money, the longs have to pay the shorts to get more exposure. But for SOI, that's not necessarily the case. Here we sometimes have phases where the shorts have to pay the longs. So where the vast majority of perpetual futures traders are betting on falling prices. It looks like the SOI price gets manipulated in the direction where most people get liquidated. Because the market makers, they make money with liquidation fees. If people have to force liquidate, if people have to sell out when they're betting on falling prices, for example, then the price shoots up and the market makers make money. Just have a look at the liquidations over time. There are millions of dollars of liquidations every single day, sometimes even above 10 million. Both on the long side, but also on the short side. Now, what's going on here? Why do so many people bet on falling prices of SOI? The answer is over here. It's the tokenomics. It's the unlocks of SOI tokens over time. The supply of SOI is growing, and if the demand doesn't grow as quickly long term, we tend to see underperformance. And so that makes SOI a good target to bet on falling prices, at least in theory. This here is Tokenomics.ai, and it shows how many unlocks are there for various altcoins. And SOI is the token with most unlocks in the next week. If there's not 131 million of additional demand for SOI in the next 7 days, SOI should do worse than average. Of course, if there's no manipulation, and that's the point of this video. SOI is an asset with a lot of leverage, with a lot of open interest, with many bets on the price, thus with a lot of manipulation as well. So an unlock like this does not directly translate into underperformance. Things aren't that easy, unfortunately. What we've got over here is the SOI dominance. How much of all of crypto is in SOI, relatively speaking? This topped out at around 0.5%, is since then hovering around 0.25 and 0.5%. And it seems like a lot of people were already anticipating the recent unlocks, and so SOI underperformed in the last weeks. Here we've got SOI relative to Ethereum. There seems to be some kind of a floor long term. And here's SOI relative to Bitcoin. Potentially a ceiling here, potentially a floor somewhere around here. And so there's a medium term support, but there's also potential to underperform Bitcoin by more than 50%. And this is now assuming that SOI can actually keep up with Bitcoin's price long term, which is questionable, right? Because again, the SOI inflation is very high and there's no demand for SOI via Wall Street or via treasury companies, etc. So SOI is 100% reliant on market makers and potentially on retail to support the price. The usage of the chain though is not high. So what we see over here is the trading volume on the SOI chain in the last 24 hours. It's a bit over 100 million. Compare this to the base chain, it's roughly 7 times more trading volume. Compare this to Ethereum, there's 1.1 billion over here, or here we've got Solana with 11 billion, or here we've got the Binance Smart Chain with 15 billion. So 100 million for SOI versus 15 billion for the Binance Smart Chain. SOI really isn't that large. It really doesn't have that much adoption yet. Here's the number of active accounts over time. There's a lot of fluctuation. At the end of May of 2024, we suddenly had 10 million new accounts. And since it subsequently deflated, it was probably no organic growth. Here we've got the number of transactions over time. Again, occasional spikes every now and then, somebody experimenting with the blockchain. but no long-term growth. Now, in terms of capital on the blockchain, it doesn't seem that bad. In US dollars, that tends to rise year over year. And measured in SUI tokens, it's not that different. Yes, within the span of the last 12 months, we didn't really see much growth, but we tend to now recover again since beginning of the year. Really, the issue is that the market makers push the price up and down via leverage of the perpetual futures, and the demand seems to not catch up. At least the organic demand, the number of active addresses, the number of transactions, etc. But because this is such a popular trade, because of the token inflation, because so many people bet on falling prices, it's very hard to anticipate what the market makers will do. I do think that it's very likely that SUI will underperform Bitcoin over the course of the next 4 or 5 years. But what it's going to do in the next few weeks or months, that's much harder to tell. Now let's take a step back. There's some interesting news happening with the money supply. The money supply is at all-time highs. And while this is not great for the average person, it is of course good for investors, because as there's more dollars floating around, prices tend to go up. Have a look at this chart. You've probably never seen this before. This is Bitcoin relative to the money supply. So we divide the Bitcoin price by USM2, and we've got a curved line over here that, interestingly enough, connects the bottoms quite well. It gives us an idea of how much Bitcoin could potentially fall right now. The potential risk is somewhere around 60%. I'm not saying that we're going there anytime soon, but it does make sense to have some risk diversifiers in the portfolio as well. Now, besides the monetary expansion, another reason why Bitcoin tends to go up long-term in US dollars is simply because of its shrinking liquid supply. What we see here is the Bitcoin that hasn't moved for the last 5 years. It's almost monotonically increasing. 30% of Bitcoin has not moved over that time period. Thus, the Bitcoin that's available for trading tends to decline over time. On top of that, we've got all of that demand by the Bitcoin ETFs. So that launched in January of 2024 over the course of 1.5 years. 3% of Bitcoin supply got acquired by Wall Street. So roughly an acquisition rate of 2% per year. And so when a lot of Bitcoin doesn't get moved, and that tends to go up over time, at the same time we see purchases by Wall Street through the ETFs, and the token inflation of Bitcoin is rather low with 0.8%. We of course have to appreciate in US dollars long term. The inflation rate of BTC is 0.84%, and in 2028 this will drop to 0.41%. And those kind of effects are the reason why this line goes up over time, despite those crashes we see every now and then. Now, on the face of it, it seems very positive that Wall Street continues to accumulate Bitcoin, because they're basically pumping our bags, right? They push up price through their demand. However, the issue is with that acquisition, the correlation of Bitcoin with other risk-on assets also goes up. So now when we see a stock market crash, we are more likely to also see a crash in Bitcoin. And the reason why this is a problem is the valuation of stocks long term. Have a look at this. This is the S&P 500 relative to gold. So this starts in 1885, a very long-term chart with massive volatility. Stocks are historically rather expensive now. And if you go back to an average level in the past, we could easily see an underperformance of 65% or so. Or have a look at the S&P 500 relative to the future earnings. So this is the Shiller price earnings ratio. It's a 7-year moving average of the PE ratio of the S&P 500. Again, a very long-term chart. It starts in 1871. This here is the Great Depression. This here is the dot-com bubble crash. This is the global financial crisis. And again, we are at historical heights. And if you go back to normal levels, we could easily drop by 50 or 60%. Now, why am I suddenly talking about the stock market? It's because things are now intertwined, right? Bitcoin has an influence on all of crypto, and now stocks have an influence on Bitcoin. Actually, when we go back to the very beginning of Bitcoin, how Bitcoin started, the very first block was mined with a message referring this newspaper article. There was an article discussing the bank bailouts. So that was the discussed issue at the time, right? Taxpayers' money is getting used to bail out Wall Street. Bitcoin got launched over here. The very first block was mined in January 2009. at the height of the global financial crisis. So during Bitcoin's history, stocks saw nothing but an appreciation. This is again stocks relative to money supply. But we can look at the same thing with stocks relative to PE or stocks relative to gold. Bitcoin has only seen positive times. The last 16 years had been incredibly bullish for investors. And so that is what worries me to a degree. That's why I want to generate returns as quickly as possible. We don't really know what's going to happen during the next financial crisis. Could Bitcoin potentially fall much more than it has ever done in the past? Could it maybe not just drop 60 or 70%, but maybe again 90% or even more, 95%? Who knows? Again, during Bitcoin's time, we've never really seen a real crisis, a real liquidity crunch. Right now, Wall Street doesn't hold a lot of BTC. Right now they're still in the minority, but as time goes on, they own more and more of the asset and thus have more impact on the price potentially during a crisis. So I'm thinking about this opportunistically. I want to pull out as much capital as possible out of the system before we potentially could see an implosion. I'm not saying it will happen. I'm just saying that in the past we had our massive crises, and these crises could spill over to crypto as well, in magnitudes most people are not anticipating. Now what you see over here is the long-term performance of these small altcoins, and this is how most people try to benefit from the system. If Bitcoin doesn't grow that quickly anymore and we want to make money fast, let's just buy these small altcoins. But the issue is that most of those altcoins perform very, very poorly, right? This is the performance in the last year, and in the last year Bitcoin actually went up by more than 60%. So buying those small altcoins is a recipe for disaster as well. But we can do the exact opposite. We can short the altcoins, and we can do this relative to Bitcoin or relative to Ethereum, and then we get a performance like this. The altcoins underperform because all of those insiders are cashing out, right? There's new tokens that get issued, maybe early investors that get vesting unlocks. And because of all of those additional new tokens and because of so many new projects launching all the time, the altcoins on average go down quite quickly. But again, if we bet on them going down, we can make money fairly fast. Here's my P&L over the last 2 months where I traded on falling altcoins. I started with 40K, made now more than 25% return already just in 2 months. And our community is doing the exact same thing, right? The individual trades make very nice returns. But really, it's about the long term. It's about compounding money fast enough. Crypto is very volatile, thus it's high risk. If we've got a lot of risk, we also need the returns. If the returns are only 1 or 2% per month, maybe 10, 20% per year, that's not necessarily enough. Maybe it's okay for Bitcoin, but it's definitely not enough for holding altcoins. My target when doing those relative valuation bets, when betting on falling altcoins, is a performance of 10% per month. Yes, I know this is risk on capital, but again, I'm also hedging this with, for example, buying gold at the same time. So I want to be risk on in crypto, and I want to be risk off outside of crypto so that it balances out over the long term, but still I take advantage of the inefficiencies of the crypto market. Because this is obviously inefficient, right? The market is going down all the time for these small altcoins. So if you want to copy trade me, if you want to learn how to set this all up, how to also properly manage your risks, then feel free to check it out. It's currently $125 per month. A link to premium should pop up directly over here on the screen. Just click on that. It will lead you to the website. If it's your very first time here, feel free to subscribe. I publish these regularly. A like would be very much appreciated as well. Helps the channel grow. See you next time on YouTube or see you in premium. Cheers.